This is a tough question, and it's because there's no real answer. Alex asks, what is the best index to use to hedge your portfolio? Okay, buy a put 6 months out. You'd want to stay with the standard indexes or ETFs, Alexander. That's my advice. That's what we typically look at. We're talking about SPX or SPY. You know, lower cost, 1/10 of the cost would still have the same percentage return, but you might need more contracts depending on what you're looking to do and your expectation of the decline to what you want to hedge. If your portfolio is heavily weighted to tech stocks, you've got a lot of stocks, mostly that are in the NASDAQ 100, you'd be focused more on NDX or QQQ. It's based on what is in your portfolio, not just what is the best one to hedge. In the past, we've also been able to use VIX as a good counter market hedge before it got too expensive, as well as UVXY. They've both declined significantly. UVXY is down to 1077. That's an ETF that you can buy. VIX, unfortunately, now the calls are still pretty expensive on VIX to use as a market hedge if things fall, volatility spikes, and the calls gain. The timing. Alexander, you're absolutely right. Whenever we talk about the time decay curve for options, you've seen us talk probably about how that when we're buying for protection, you know, either in a married put or even speculating on a market move, we want to be buying 120, 150 days out in time because the time decay is more slow. Whereas in this time period, 60 to 30 days, we see the most rapid time decay. Here's probably about 90 days. This is more like 150. I'm sorry, folks. This would be your 120. And then we get, you know, sort of closer in here to 90, 60, and then 45, and then 30, and then 15. Okay. So let's clear that up and redraw all that. So you're absolutely right. You probably want to look at least 2 to 3 months out in time. Going 6 months out is not a bad idea either, depending on when you think the decline is going to occur. If you're planning for the decline in the next 20 to 40 days, going 90 days out, double the time that you expect the decline to happen is still pretty good. It's still probably within the range of what you'd look for and is still keeping the cost low to hedge the portfolio as well. And going 6 months out at that time is not bad either because that also gives you time to manage it. If the fall doesn't happen as you're expecting, Alexander, you'll be able to manipulate or roll the hedge itself to keep you from losing more on the hedge. But if you're losing on the hedge, you're gaining on your portfolio, so you're still looking all right. You're still looking okay. So which index to use? Analyze your portfolio. Where are the stocks that you have in your portfolio or even the positions? If you're trying to hedge a bull put credit spread portion of your portfolio, which is what I do with either ETFs or the volatility ETFs or the VIX, to hedge that portion of my portfolio, if there is a sudden market downturn, I know I can be down 30 to 40% of that 10 or 15% allocation to the credit spread positions. That's just the nature of the trading. It's just the nature of the spreads. But I want to see what kind of stocks am I in right now? Meaning, am I in tech stocks? Am I in S&P 500 stocks? What stocks best what stocks are best matching that portfolio? Which index or ETF best matches what's in the portfolio portion I want to hedge? And that's the index and ETF you're going to target. That's what you need the most. So when things fall, those stocks start to fall and go against you with that portion of your portfolio, you know the ETF is most likely rising to counter that as well. There are a lot of videos available as well that you probably want to take a look at that go more in depth. Right there on that webinars page also, Alexander, I go to free webinars. Of course, this is just sorry about that. That's just a standard page there. Public page, sorry, I meant to say, Alexander. So it's powerop.com/webinars.asp. There you go. And I think it's under options concepts. There's a look at the stock repair. Analyzing hedges on large portfolio exposure. That was for September. We discussed hedging a large portfolio with married puts, collars, or deep in the money covered calls. Maybe that's not the one I want. This one's the one I wanted. My apologies. It was a week before that, Alexander. Hedging leverage positions in your portfolio. In light of recent declines in the market, what technical indicators might be used as a trigger to exit a position and hedging a portfolio in these declines? We take a look at a portfolio of long calls, how they fared the past few days with both compared to broad market hedges using VIX calls, SPY puts, shares of UVXY, and others. So this will give you sort of an idea. I don't think we looked at QQQ versus SPY in this case because most of the bought calls in the example were focused, I believe, on S&P 500 for that exercise. However, that is a good one to use. Here's another one from April, how to hedge your portfolio with broad market put options, a look at hedging a bullish stock portfolio with ETF or index options, calculations to cover loss, adjusting or rolling the insurance, protecting only part of the projected decline. That's also important. I think that's the best one for you to start with, Alexander, if you have time this weekend. It's about 30 minutes long, I believe, how to hedge your portfolio with the broad market put options. And this one I think is important because it does talk about adjusting, but more importantly, it talks about the idea of only protecting part of the projected decline. What do I mean by that? If you're expecting, let's say, a 10% decrease in the markets over the next 2 months, SPY, QQQ, what have you, you don't want to structure and buy so many options, so many put options that you're hedged out to zero loss if it falls 10%. That's not what you're looking to do, because if you're wrong and it moves up, you're also gaining 0%. Okay? So you can hedge yourself out too much. What you're typically trying to do, and this video shows how to do the calculation, is how to hedge your portfolio with broad market options from April 22nd, 2020. It's showing you that if you're expecting a 10% decline, how much insurance do you need to protect half of that? So that if it does fall 10%, you would only lose 5% on the portfolio. Trying to hedge the full 10% loss will hedge you out too much. And if the market goes up and the decline doesn't happen, you're not going to see the gains on your portfolio because you're too hedged out because of the cost as well. Okay, so don't want to say I'm giving you homework, but these are the more in-depth discussions than we'll go into right now, Alex, for that. But it's going to give you a very good idea. The true answer to your question is analyze your portfolio, figure out which index or ETF is the most closely related to the movement of your stock positions or your options positions in your portfolio. That is the one that you want to target. Okay. That's an interesting comment by Kipp. All right, so Alexander, thank you for the great question. If you have any further follow-up questions after you watch that webinar there from April 22nd, 2020, just let me know and we'll be more than happy to walk through it as well. All right, so let's go back here. Kipp, I like this question. I like this observation. I'm sorry, Kipp. Just a quick comment from Kipp. He says, just an observation, an interview with Thomas Petterfee of IB noted that for the first time ever, IB option clients are now net short. And it's an interesting comparison with the Robinhood options traders who are opposite, I believe, is what you're saying, Kipp. So that's pretty interesting. What he means is the IB positions, interactive brokers, they're the first time ever, the options clients are now net short, meaning they're expecting a decline, I'm assuming, is what we're referring to. They're not just short puts, which could be bullish, or doing bull puts, which are considered a net short, but he means net short as in they're taking bearish positions, they're stacked bearish positions, whereas Robinhood appears to be the opposite. All right, I'm going to start. Yeah, we're just going to go in order. That's good enough. So, Kipp, thank you for that comment. That is very interesting. It's never a bad idea to hedge. Remember, at the beginning of the year, 2020, we were having questions. The first couple videos or questions about the market sentiment came in when it started to go to a sell warning, and we had about 2 or 3 discussions leading up to February 26th. I think there was one on February 10th, and then one later, right around Valentine's Day on February 15th, and then one right on the 20th related to market hedging. These ones came later after the decline, but there were 2 or 3 other webinars on hedging. I was in VIX calls because at that point, the VIX was still at 14, 12, might even been at 11. So I had VIX calls leading into February. So when that decline happened, I started selling half, and then I sold another half when it went down again. Then it went down again, meaning the VIX is going up to 90 from 16. That was my market hedge, was the VIX. But then after that, calls were too expensive. The calls on the VIX were too expensive. So I moved to just buying shares of UVXY and, of course, SPY. But we weren't doing protection at that point. We were speculating around April, buying September and August options on the large stocks, Costco, Clorox, things of that nature. And that was also in that video that we posted, the market guidance, around March 2nd of 2020, I believe. Okay, so Wendy asked, related to what we were talking about a while ago with the time decay curve. Wendy says, can you please explain the time decay of options? Yes, this is the thing I was trying to draw. This is the common way of how options decay in price. Now, we're going to look at this in an option chain in a second, Wendy. And what you typically see is that the option that is 6 months out in time, we were looking at June, for example, and I'm going to take RBA again. So that June 75 option, let's say the call option, the June 75 call for 6 months out might be priced at around $6. Okay. That's not 1 month out, but the January, if it offers a January 31st, 1 month out, essentially, the Jan 31st 75 call, which is only 1 month out, might be priced at $2. Okay, why is that important? Because the option that's 6 times the amount or 5 times the amount out in time is not 5 times the cost. It's not at $10. It's only sitting at 6. That's the nature of options. You get a lower cost per day when you buy further out in time. Even though you're paying a higher upfront price, Wendy, you pay a lower cost per day. Which means that if my option's out here 180 days, I'm going to see in the first 30 days, let's say 150, I'm sorry. In the first 30 days, my option, my $6 option, might only decay 45 cents. This January 31st option that was at $2 in the first 30 days, if the stock doesn't move, of course, Wendy, it stays at 70.43, that time value is going to go. It's going to lose $2 in 30 days. I'm only going to lose maybe 45 cents, maybe 50 cents. The next 30 days, stock does. So then we hit January 31st. My June 6 option is down to 545, 550. All right, I lost my 50 cents of time decay in the first 30 days. You lost the full $2 because it didn't go up above 75. Now you buy a February 75 call for, let's say, $1.75. And over that time period, it doesn't go up above 75. It stays at 70, 71, 72. You lose another $1.75. You're only down $3.75. I might have lost 60 cents. Now I'm only down $1.10 by paying $6 up front. This is assuming a lot of things. This is assuming that volatility is staying the same and the stock isn't moving, of course. But that's the idea. When you're buying options, you don't want to buy week by week by week or month by month by month because you pay a higher annualized cost and you suffer a more rapid time decay in the short term. However, when I'm selling, I want to be selling week by week or month by month because I'll get a better annualized return than selling 6 months out at a time, even though the cost is higher. But it's not 5 times the cost, it's only 3 times the cost. Okay, so when you sell, you want to be getting this time decay in your favor. When you're buying, you don't want the time decay to work against you because that's effectively your loss. Now let's switch back over to power options. We'll see a quick example of this. I'll stick with, my apologies, I'll stick with RBA. This would help things clear up, wouldn't it? There we go. All right. So let's go to the chain for, no, I want to go to the custom spread tool. We're going to use that exact example. We're going to take RBA, and I'm going to look at the, okay, that's 3.5 times the amount out in time. It's not really good that way, but we'll do it. I'm going to use June versus February. February is 51 days out in time. June is 170 days out in time. All right, so we're going to use February. I'm going to look at the 75 call. Okay, here it's worth $1.30. Midpoint is going to put us at a different price, 145, I think, right? Yeah. Okay, so, all right. Now, 51 days out in time, I have a price of 145. Standard graph. Now down below this, Wendy, we have a thing that helps you calculate your results. So let's say the stock only goes up to $72. And in the first 30 days, to January 26th, still about 15 days left, what would we expect? Okay, that's not too bad. That's a time decay of 35 cents. But if we go all the way to February expiration, 51 days, what's going to happen? We're going to lose the full $1.45, right? 51 days, stock doesn't go above our price, waffles a little bit, stays at around 70, 71, 72. We're not going to see a great increase in this price. And 51 days later, we're out $1.45. Now let's take the same scenario, but with the June series. Buy the June option, 75 call, priced at 430. I didn't submit it. That would help, wouldn't it? All right, 460 is our midpoint. All right. Now, same thing. Stock's at 72. What was February? Was it the 19th? I'm sorry, folks. Sorry for the scrolling. February 19th. Yes. So what happens if the stock is at 72 on February 19th with our further out option that we paid more money for? That's 219. This is probably too high of a volatility. Let's bump it down here. Let's bump it down to 0.287. Okay, so I lose 114 maybe in this case. I'm curious. I want to see what the volatility on this option is. The SIV is 3.0. That was at 3.8 in that case. So here we only lose 114 over the same time period. Less than what we would lose with the shorter term option because it decays faster. You have a higher annualized cost in that case, right? All right, so I wanted to look at this option real quick. That implied volatility showed us that we'd only see a 20 cent decline. And I just don't think it's 0.3469, sure enough. And it spiked 0.33, 0.35. I think the average is at 0.33, 0.34. Okay, so that does, believe me, that does matter. Implied volatility does have that effect. Let's do that again, but at 0.33. Okay, yeah, that's, so we'd lose about 45 cents with our 6-month out June option in the first 50 days. Stock staying around the same price, even moving up. It did move up a little bit to 72. But whereas your shorter term option lost the full 145, the longer term you'd only expect a decay of what I said, 45, 50 cents along those lines. The IV was too high at 3.6 with a recent spike today, so I don't think that's realistic. I think it's more around 0.3, and this is what I would expect to see. That's the time decay. The farther out options decay more slowly.